The stupendous upsurge in the Indian benchmark indices, the S&P BSE Sensex and the Nifty 50 has given rise to valuation concerns in the past few months at a time when commodity-priced fuel inflation concerns are rearing their head again. After UBS, which downgraded India to underweight from overweight, now Nomura has also downgraded Indian equities to neutral from overweight, citing unfavorable risk-reward. Nomura has said, "We now see an unfavorable risk-reward given valuations as a number of positives appear to be priced in, whilst headwinds are emerging. India's valuation appears very stretched, as 77% of domestic stocks in the MSCI index are trading higher than the pre-pandemic or post-2018 average valuations. The rise in inflation coupled with high valuations has triggered a correction in the past few sessions, which has seen the Sensex slip below the 61,000 mark and the Nifty below 18,000. The price to earning ratio, or the PEs, is one of the most widely used tools by which investors and analysts determine a stock's relative valuation. Amit Sachdeva of HSBC believes high PE of Indian equity benchmarks is the new norm in the liquidity-driven market, but not all are convinced. A quick check of the stocks that comprise the BSE 500 index reveals startling results. Some stocks like Piramal Enterprises, Ujjivan Financial Services, Adani Green, Route Mobile, and IDFC are trading at an astronomical PE of 545 times to 910 times their FY22 earnings. Santosh Singh, head of research at Motilal Oswal AMC, says any liquidity-driven rally that is not backed by fundamentals will not last.
Biggest worry, because the recent sort of rally in the market was not based on a lot of fundamentals, but a lot of stocks were just going up because someone was just willing to buy it at any price. Now, so as you're pointing out, certain places the valuations went into triple digits, and even on a forward basis, they are in triple digits at a lot of places, or even high double digits. 50p, 40p, even these are unheard of valuations for a lot of sort of sectors and a lot of companies. So I definitely agree that this correction is more because of the valuations and less because of the fundamentals. So see, when the valuations are because of liquidity, they never sustain. Valuations can only sustain if they are because of fundamentals. So it can sustain for 6 months, a year or something. So if the basic argument is liquidity and lower interest rates, those valuations were never going to sustain.
Does this mean there's more pain in the store for the markets?
I'm not really worried about the markets per se, because there are certain areas which are not so I would say fancy, and there the valuations are lower, and I think the highest amount of earnings upgrade is going to happen in those particular areas. So one of the areas which I keep pointing out is financials, which actually, if you go into the rally of last 6 months, didn't participate. So I think that will be one area which will actually be able to sort of control the markets, the market fall. But yeah, the stock fall in the areas which are very high P are going to be significant. That's my view.
Given this, the road ahead for the markets looks choppy, with stock-specific correction taking the center stage. On an immediate basis, corporate earnings will sway the market mood today, as many prominent names like the Axis Bank, Bajaj Finance, Cipla, and Dr. Lal Path Labs are set to report their results.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.